Hello, welcome to Accounting Hub. I'm Professor George Carpin, PhD in accounting, and our topic today is periodic inventory system. When we talk about inventory, we have two types of inventory: merchandising and manufacturing inventory. Manufacturing inventory, it is not our topic today. However, we have videos about manufacturing inventory. Check it out. They are in our video description. And merchandise. This is our topic today. Goods that are purchased primarily in finished form from wholesalers and retailers. So, what is the basic difference? Merchandise. I purchase A, I sell the same A. I purchase soda, I sell soda. Manufacturing company. I purchase woods, I sell furnitures. So I purchase A and I sell X. Okay? So the cost of merchandise inventory includes purchase plus any other costs necessary to get goods in condition and location for sale. For instance, shipping. We add it in our purchase price. And we have two methods. The first one, we will not have it here today. However, we also have a video about that, and they are in our video description. That is repeatable inventory system. That is when we continually adjust the inventory account for each change in an inventory caused by purchase, sale, or return, and we also adjust the cost of goods sold. This is the topic that we will be working today. Periodic accounting inventory system. Adjust the inventory accounts and records cost of goods sold only at the end of each reporting period and not after each sale. Records merchandise purchase, purchase return, purchase discount, and freighting in temporary accounts, and we close it, and at the end of our period we have our cost of goods sold and ending inventory. And the cost of goods sold, we have a formula: beginning inventory plus net purchase less ending inventory. That is only a logic formula. For instance, let's work with physical units, and then money is a physical times price. I start my inventory with 10 sodas. I purchase 15. If I haven't sold any soda, I would have 15 sodas. I don't know how many units I sold, but I know that I have 9 in my ending inventory. So to balance it, I must have sold 6 or lost it and so on, but we add everything in our cost of goods sold. Okay, guys, so let's check it out. Whoa. In our Excel file. Here, it's much easier for us to understand it. Guys, if you are a regular here, you already know that. If you are not, I want to let you know that all our Excel files, they are free to download it, and the link to the Excel file is in our video description. Okay? So the Skyping Corporation purchased baby toys from producers and then sell them to customers. The company begins 2020 with inventory of $200,000 on hand. The following information relates to inventory transaction during 2020. Additional inventory is purchased on account at a cost of $900,000. So we record it in a temporary account called purchase. So purchase $900,000, and it is purchased on account. So accounts receivable $900,000. Okay. Sales of the year all on account totaled $1,837,500. So we record the sales. Accounts receivable 1,837,500 here. No cost of goods sold is recorded here only at the end of our period. Let's consider now we are at the end of our period. So let's go to our formula. Let's go to our flow or inventory flow here. Beginning inventory, $200,000. And this is our beginning balance on inventory. Plus purchase. Purchase is here, $900,000. Beginning inventory plus purchase is equal cost of goods available for sale, $1.1 million. Less, how much is our ending inventory? After a physical count of inventory at the end of the year, the cost of ending inventory is determined to be $260,000. Remember our soda. We start our period with 5 sodas. We purchase another 10. So our cost of sodas available for sale, 15. My ending inventory, 6 sodas. So we purchase 9. That is cost of goods available for sale less ending inventory. However, okay, this is beautiful. However, we have a problem here. Our inventory, our ending balance here is 200. It's wrong. Purchase 900. It is temporary account, so we must close it. And we have no cost of goods sold. So let's do it. We need to close our purchase. So if we have a debit here, we must credit it. Let's close it. Perfect. We need to adjust our inventory. So we need to close these $200,000 here because we don't have this beginning inventory anymore. And our ending inventory, 260. That must be our ending inventory. So here, 260. That is our ending inventory. We're good. And what about the cost of goods sold? Is the number to balance it? And here, guys, let's check it. It's our formula. Beginning inventory plus purchase less ending inventory. Or we have it here, 840. And if we sum it here, 1.1 million, $1.1 million. That our sum will always be the cost of goods available for sale. We have here some of our credits, some of our debits. Accounting is beautiful. Okay, guys, so that's it. Subscribe our channel, guys. You will be the first one to know when a new video arrives. Like our Facebook page, Accounting Hub by Dr. Scarping. Like this video. If you have questions or comments, leave it here or email me at jscarping@gmail.com. Have a very nice day and God bless you.